So finally, we get to the question that most of you are probably wondering, which is how much money do I actually need to raise to get my product out into the market? There's a saying in startup companies that cash is king, because at the end of the day, you're still a going concern, your company is still in business as long as your bank account is above zero. The minute your bank account is at zero, that's the end of your company. The most critical piece of information to determining what your cash needs are is that operating profit and loss that we looked at on your income statement. First thing you do is go ahead and pull in this information here on the top line. This will be the source of most of the cash that you actually require. There are some other adjustments that you can make along the way that will impact your cash. This has mostly to do with accounting and some of the very strange accounting rules that we run into. For the most part, what you want to do is go ahead and plug numbers into this spreadsheet to understand the adjustment that you need to make to your operating profit and loss to calculate the amount of cash that you need. The other thing you're going to want to do is account for the amount of inventory that you need to actually have on hand. Not surprisingly, you need to buy raw materials and store them in your company before you can actually sell the device to an end customer. This requires cash. And again, it will be a use of cash that you actually need to apply to your cash requirements. Once you add up the cash that you will be required each year, you can create something called a cumulative cash flow. You use that cumulative cash flow to determine how much money you actually need to raise each year. This calculation here essentially calculates the amount of cash that you have in your bank account, and then therefore how much money you actually need to raise to determine how much money is required to build this company. For this particular example, what you can see is that in the first year, the company spends a little over $2 million. So a good practice would be to raise more money than you actually need to spend. So the CEO and the rest of the company went out and raised $3 million. Well, if you go ahead and look at year 2, you can see right here that the company is going to spend $3.5 million. But the company may not want to raise money every single year. So as a result, they've gone ahead and tried to raise enough money to cover all of year 2 and year 3 and most of year 4. That's why the amount of money that the company raised is $12 million. Usually you raise money associated with a particular set of milestones. You want to raise money after you've successfully completed some activities that actually grow the value of your organization. So for example, in year 1, this company was building prototypes and demonstrating functional success of their product. So they raised money, did all of that work, grew the value of the organization. The next 2, 3, and 4 year was really about getting the product out into the market and getting some initial experience. So the company raised enough money to cover all of the activities required to get the product into the market and actually generate some income. Finally, in year 4, the company needed to raise enough money to cover all of the costs of commercialization, which is why you see a much larger number here to cover all of the significant costs that are associated with years 4, 5, and 6. So in summary, I've walked you through a very simple financial model that you can use to generate all of the assumptions that you need to understand your business. This is a critical activity because it helps you understand the amount of profit and loss that your business can generate, as well as the amount of funding that you need to get your product to the market to help patients and improve people's lives. At the end of the day, the model that you build is only as good as the amount of detail and effort that you put into it.